Welcome to this lecture on the limitations of internal controls. In this session, we'll explore why even the most carefully designed control systems cannot guarantee absolute assurance, and how organizations can manage these limitations effectively. Internal controls are vital to ensuring accuracy, compliance, and operational efficiency. They help prevent fraud, detect errors, and safeguard assets. But it's important to remember, internal controls are designed and operated by people, and because of that, they will always have inherent limitations. Understanding these limitations is key to managing risk realistically. The COSO framework emphasizes that internal control provides only reasonable assurance of achieving objectives, not absolute assurance. This means controls can reduce risks to an acceptable level, but they can never eliminate them entirely. Let's examine the major limitations one by one. The first limitation is human error. Mistakes happen. Employees may enter incorrect data, overlook steps in a procedure, or misinterpret instructions. Even when controls are well documented, errors can occur due to fatigue, distractions, or lack of training. For example, a staff member might approve a payment without verifying documentation properly. Regular training, supervision, and process reviews can minimize but not eliminate this risk. The second limitation is collusion. Internal controls often rely on segregation of duties, ensuring that no one person controls all aspects of a transaction. However, if two or more employees collude, they can bypass those controls entirely. For instance, a purchasing manager and a vendor might work together to approve false invoices. This is one of the most difficult types of control failures to detect because the control system itself appears to function properly on paper. The third limitation is management override. Senior management has the authority to override established controls, approving exceptions, altering reports, or influencing decisions outside normal procedures. While some overrides are legitimate, unethical management overrides can conceal fraud or manipulation. Strong governance oversight and an independent audit function are essential to mitigate this risk. The fourth limitation is cost versus benefit. Designing, implementing, and maintaining controls involves resources, time, money, and personnel. Organizations must balance the cost of a control with the level of risk it addresses. For example, implementing a sophisticated automated approval system for minor transactions may not be cost-effective. The goal is to achieve efficiency without compromising integrity. The fifth limitation is changing conditions. Business environments evolve rapidly. New technologies, regulations, or market conditions can render existing controls outdated or ineffective. A control that worked perfectly last year might not address today's risks. That's why continuous monitoring and periodic reassessment are essential to keeping controls relevant. The sixth limitation is judgment in decision-making. Many controls depend on human judgment, evaluating creditworthiness, assessing risk, or estimating future costs. Even with guidelines, individuals may make different judgments under similar circumstances, leading to inconsistencies or biases. It's also important to acknowledge external factors beyond management's control. Economic crises, natural disasters, cyber attacks, or sudden regulatory changes can disrupt operations and render even the best designed controls temporarily ineffective. These limitations do not mean internal controls are weak or unnecessary. Rather, they highlight the importance of realistic expectations. Controls reduce the likelihood of problems, but cannot make an organization completely risk-free. Organizations can manage these limitations by promoting a strong ethical culture, reinforcing accountability, and maintaining open communication. When employees understand the purpose of controls and feel empowered to report issues, the overall system becomes more resilient. Technology can also help address some limitations. Automation reduces human error, analytics detect unusual patterns, and continuous monitoring tools flag potential control failures early. However, even technology requires human oversight. Systems must be configured, interpreted, and updated regularly. A critical defense against control limitations is the 3 lines of defense model. The first line, operational management, owns and executes controls. The second line, risk and compliance functions, monitors and supports the first line. The third line, internal audit, provides independent assurance. When these three lines work together, they strengthen control reliability and transparency. Let's consider a practical example. Suppose a company implements an automated approval process for expense reimbursements. The system enforces spending limits and documentation requirements. However, if managers share their login credentials or override approvals, the control's effectiveness is compromised. Regular monitoring, audits, and a culture of accountability are what keep such controls functioning as intended. To summarize, internal controls have inherent limitations due to human error, collusion, management override, cost constraints, changing environments, and reliance on judgment. Organizations cannot eliminate these limitations, but they can manage them effectively through strong governance, continuous monitoring, and ethical leadership. In our next lecture, we'll discuss designing internal control systems, where we'll see how to build effective, risk-based control structures that balance efficiency with protection. Thank you for joining me in this session on the limitations of internal controls.